Here is why I'm pretty confident that gold has hit an intermediate bottom. We could head lower. It's still possible. It just doesn't seem likely given the evidence I'm about to show. So here's the first step of it. The first installment of this evidence comes in what is called, I guess, a bear trap reversal. I guess you could call it other things. I'm not really a technical expert, but I do look for this specific sign when we encounter bottoms. So you would expect when that bottom is broken, once the next and final money printing round of quantitative easing inflation begins because of some banking crisis that is bound to happen pretty soon, that will trigger the loss of reserve currency status in favor of gold, which will be money and traded, and international trade will be based on gold again for lack of any other alternative.
Gold's recent pullback appears to have shaken out weak hands, but the broader trend may be sending a very different message. Price action around key support levels has created growing speculation that a meaningful turning point has already formed. Rafi Farber, a market commentator known for his focus on monetary history, sound money principles, and long-term trends in precious metals, argues that recent volatility should be viewed in the context of a broader monetary transition. He believes that short-term weakness in gold has produced a classic bear trap reversal, in which a breakdown below key lows attracts sellers before prices quickly recover. Evidence from previous market bottoms suggests that this type of action often appears near significant turning points. While he acknowledges that additional downside cannot be completely ruled out, the balance of evidence appears to favor the view that an intermediate low has already been established. The recent recovery following the breakdown of support has strengthened confidence that the correction phase may be nearing completion. If this interpretation proves correct, gold could begin rebuilding momentum as investors increasingly focus on monetary instability, debt pressures, and the long-term implications of central bank policy. Now, we present the clips from Rafi Farber's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Here is why I'm pretty confident that gold has hit an intermediate bottom. We could head lower. It's still possible. It just doesn't seem likely given the evidence I'm about to show. So here's the first step of it. The first installment of this evidence comes in what is called, I guess, a bear trap reversal. I guess you could call it other things. I'm not really a technical expert, but I do look for this specific sign when we encounter bottoms. And we have had this pattern before when we had previous bottoms in gold. You see here, we had a bottom in gold around March 23rd at around 4,100. I think it was a little bit lower, $4,086. So you would expect when that bottom is broken, as it was over here, and it looks like June 13th, June 14th, maybe it was June 11th, could be, yeah, June 11th. We had follow through. We had actually a break in the low over here, which you would expect would trigger a lot of sell stops, which it actually did, which is why you have this candle going below here to about 40.30 something, 40.32 maybe. So we had a break of major lows in gold for about 2 days here, but then there was almost no follow through at all, an immediate reversal. Now, that alone is not enough to convince me that we have a bottom. We could try to test that again in the future, theoretically, but here's why I don't think we will, or at least if we do test again, we're not going to break it. That comes in this chart over here. There's high deliveries and little futures activity. What I mean by little futures activities, most of the trading, most of the new contracts being open are being opened in the spot contract, and you can see that every time there is a dip in the gold price, there's a huge spike in deliveries in warrants. Warrants are one specific gold bar that is represented by the contract. It's not a theoretical gold bar, it's an actual one that has a warrant attached to it. And the interesting thing, or the critical thing about getting warrant deliveries, is that to get a delivery, you require all cash to be in your account, so you can't use leverage. You can use leverage to trade futures. You only have to put up whatever the margin is, 18, 19, 20%. I forgot what the exact number is, but you need a lot less cash. If you want a warrant, you got to put up all the cash. So you got to be willing to do that. And what we see here is that we have these spikes in deliveries from immediate spot contract buying on days when gold dips. And we saw that during the bottom over here on June 15th. when we had a reversal and a failed breakdown from a tag of the double bottom at about 40.80, 40.50. A little bit of a marginal breakdown, but no follow through. Why I think this is a convincing bottom is that whenever we go down to about 4,200, 4,100, there's these spikes in delivery statistics, which means that traders or investors are willing to put up the cash for a warrant of actual 100-ounce bar of gold once the price dips below 43, 42, 41, whatever the case may be on that day. That means there is fundamental physical demand at these levels, which I don't think can be broken, which means whenever speculators drive the price below that shield or that level, the physical demand picks up again, and you can see that through the deliveries. And I'm going to continue that over here. You can see that in the latest statistics for trading in gold futures, we're looking here at the open interest changes, how many new contracts are being opened, how many new contracts were opened yesterday when gold ostensibly bottomed. You can see that most of the activity was in the spot contract in June for immediate delivery. This is not futures because when you buy this contract within the delivery window, as I said before, you have to put up 100% of the value of the warrant. You can't just put up the margin as you can if for July, August, September, etc. There was a little bit of activity in the December contract, up 948, but most of the activity was in the spot contract because we see here we have an increase in 569 contracts with 706 deliveries. So that means we had a net increase yesterday of 706 plus 569 because normally this takes away from open interest. If you have 706 deliveries, that should bring open interest down by that number because those contracts close through a delivery. But the fact that it went net up 569 means that we had a net movement of about 1,275 contracts in the spot June contract. So that is much more than all of these combined. These we fell despite gold bottoming here and moving up yesterday. You would expect some speculative activity and open interest to increase, but we did not see that. Next thing that is peculiar about this bottom is that the ETFs aren't participating either. There's no speculative fervor in the gold ETFs, neither GLD or AIU. We'll go into the numbers right here. You can see here these red bars are the ETF losing gold. Every time it goes down, that means the ETF sells gold in order to keep its share price in line with the gold price. And the fact that it's selling off gold to do that means there are very few speculators that are interested in the fund right now. So it's been losing gold since March, since after the top here. The top was over here. You can see here's the GLD price. And the speculation increased until about here when gold retagged about $5,000 an ounce, or 5,250. Was it 5,300 even? And since then, the fund has been losing gold, and it hasn't increased any amount of gold since May. And we see the same thing in IAU, the other popular gold ETF. You can see here that it is a new low since September of last year in terms of the amount of gold stored in the fund. So there is no speculation, there's no speculative excitement going on in any of the ETFs or in the futures trading at all. And what is also very peculiar about this bottom is that open interest overall is still near 20-year lows at about 2008 lows, about, was it 19, 18-year lows? This is remarkable, actually. There's nothing going on at a retail level or in the futures trading at all. So what is causing the gold price to rise? I guess marginal buyers that are very few and far between. Imagine what happens to the gold price when consciousness wakes up, when bullishness wakes up again, once we start the new round of money printing on some kind of banking crisis that is surely headed our way with interest rates heading higher because of increases in consumer prices. What the Keynesians call inflation, but what is really just the effect of inflation, which is the increase in the credit supply, which is the dollar.
The analysis also emphasizes the relationship between financial system stress and future monetary responses. Markets continue to face pressure from rising debt burdens, fragile banking conditions, and persistent concerns about currency purchasing power. These factors are viewed as supportive for hard assets over the longer term. A key argument is that future economic weakness could eventually force policymakers back toward aggressive liquidity measures. Such a shift would likely increase concerns about inflation and confidence in fiat currencies. Under that scenario, precious metals could attract renewed investment demand as investors seek protection from financial instability. The recent technical behavior in gold is therefore being interpreted as more than a routine bounce. Instead, it may represent the early stages of a larger trend reversal that becomes increasingly visible as economic conditions deteriorate. Now let's get back to the interview.
How do you expect total reserves to change 5 years from now? So, in the higher section, what part of your reserves is going to go higher? 84% said gold, 67% said RMB, which is the Chinese renminbi or the yuan, 42% said the euro, and only 11% said they're going to increase their holdings of USD, whether that's through cash or treasuries, usually treasuries. And only 11% said that their amount of gold would remain unchanged, and only 15% said the amount of US dollars remain unchanged. And lower, what's going to go lower? Only 5% of respondents said that their gold holdings are going to go lower, and 74% answered that they expect US dollar holdings or US dollar derivative holdings like treasuries to go lower. That's most central banks. And you can see here in the asterisk combined moderately and significantly responses. So 74% of central banks believe that their dollar holdings, US dollar holdings, will go down either moderately or significantly, and 84% believe that their gold holdings will go up, moderately or significantly. Does this mean that the dollar is losing reserve status? And you might be surprised by my answer, but I say no. It doesn't mean that the dollar is losing reserve status for two reasons. First of all, the other currencies that are part of this questionnaire, RMB and Euro, and probably other currencies too, they are all dollar derivatives. They are dollar derivatives because of the skeleton system of what remains of the Bretton Woods Agreement. All of these currencies have a goal of maintaining a certain exchange rate with the dollar, which means if they go out of that window, the central bank has to buy dollars or sell dollars in order to maintain that window, which they do. All these other currencies were born as dollar derivatives since World War II, and they will all die as dollar derivatives. The only one that cannot die, as it is not a dollar derivative, is gold. And now you'll ask me the question, well, if gold is not a dollar derivative, and it isn't, because gold is money and the dollar is a gold derivative still, with a lot of debt on top of it, yes, but it's still mainly a gold derivative inflated by a bunch of debt on top of that derivation status. You'll ask me, well, Rafi, if central banks are almost entirely in agreement that they will be increasing their gold reserves, then doesn't that mean that the dollar is losing reserve status? And my answer is still no. Because the reason that central banks buy gold is not to make it convertible into their currencies or their currencies convertible into gold. They buy gold in order to sell it to strengthen their currencies. And strengthen their currencies relative to what? Relative to the dollar. It's in order to keep those exchange windows. Yes, the dollar will lose its reserve currency status. That will happen. But it's not going to be a gradual process. It will be sudden once the next and final money printing round of quantitative easing inflation begins because of some banking crisis that is bound to happen pretty soon. That will trigger the loss of reserve currency status in favor of gold, which will be money and traded, and international trade will be based on gold again for lack of any other alternative. It's not anything that anybody wants, but there will be no choice at all, and we'll have to go back to money, and we'll have to go back to a more balanced society and watch all of centralized industry pretty much crumble at our feet and disintegrate. And it's going to be a big rebuild from there, but it's going to be very healthy for our species, for the planet, and for whoever lives in this quadrant of the galaxy, if there's anybody else out there. For the first slide, something I didn't talk about in the summary, but stocks are back at the 1929 bubble top relative to money, meaning relative to gold. The gold to S&P 500 ratio is the same now as it was at the 1929 bubble top high. I drew two red lines here. You can see this is the 1929 bubble top. This is the Great Depression over here, and Great Depression valuations of the S&P 500 continued throughout the 1930s and 1940s until we started pulling away in 1950 until the 1970s at bubble top or 1968 bubble top when the gold pool, the London gold pool finally broke in 1968, and this was the end of the gold window over here in 1971, and from that point on stocks started to descend into the 1970s with a little bit of a recovery here, akin to the current correction that we've had in gold for the last 4 or 5 months, and down into the depression bottom in stock valuations relative to money. So you can see here that 1980 was about the same as the 1932 bottom in the valuation of the S&P 500 relative to money itself. And we're back right now at the 1929 top, which is significantly lower than we were in 2000, 2001, which is the king ultimate mega crazy bubble top. We called it the dot-com bubble, but it was really a bubble of all stocks relative to gold, as we can see here. Here's the 2011 bottom in stocks relative to gold, September 2011. And it looks like we have gotten a head and shoulders topping pattern here long term going back to 1968. I don't think we're going to head much higher than this at all. And we're going to hit the 1980 lows, which correspond to the 1932 and 1938, looks like 1943, 42, World War II stock bottom relative to gold. We're going back there, and when we do, it will be the end game. Because so many people now, so many more people are invested in stocks. That means that so many more people are going to lose their portfolios, lose their purchasing power, and it's all going to go back into gold as it was in 1980 and 1932 and 1940s during World War II.
Beyond the immediate price action, the broader outlook centers on the future of the international monetary system. The expectation is that structural weaknesses within the global financial framework will become more difficult to manage as debt continues expanding faster than economic growth. If another banking crisis emerges and authorities respond with large-scale money creation, confidence in traditional currencies could face renewed pressure. One of the more ambitious projections presented is that gold may ultimately play a much larger role in global trade and monetary settlement than it does today. While such a transition would likely occur during a period of considerable economic disruption, it is viewed as a possible consequence of declining trust in the existing system. Historical comparisons, valuation measures, and long-term gold-to-equity relationships are cited as evidence that major adjustments may still lie ahead. Although timing remains uncertain, the overall thesis suggests that the current environment favors tangible monetary assets over financial assets. If future liquidity programs return on a large scale, gold could benefit significantly as investors search for stability, scarcity, and protection against currency debasement. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.